Right, Ghana's Monetary Policy Committee ends a two-day meeting today to review interest rates in Sub-Saharan Africa's second largest economy. To preview the possible outcomes, I'm joined by Razia Khan, the head of Africa Research at Standard Chartered Bank. Thank you so much, Razia, for joining us on the show today. And maybe before we get into the discussion around the MPC's decision, of course, you must have seen the producer price inflation number come out at 10.2%. That's down from 10.7% in the previous month. Is this something that will have any bearing in the monetary policy decision today? And maybe before that, did the figure surprise you? Because we have seen the CPI tick higher over the last few months.
Not necessarily. What we've some time now is a very low correlation between the PPI and the CPI. We should not forget that in the case of producer price inflation especially, there is a substantial base effect that has been driving that lower. So even though we see this deceleration in year-on-year producer prices, how meaningful is it? Not very meaningful at all. We've seen consumer price inflation behaving differently.
Right.
We've seen even more pressure on inflation since the fuel price adjustment in Ghana earlier this year. And that, as well as pressure on the currency, is what we believe the Bank of Ghana are likely to react to.
Right. So inflation up to 10.6%. What decision are you anticipating today?
Well, we have a very non-consensus view at Standard Chartered. We think that the Bank of Ghana will tighten interest rates, tighten monetary policy generally. We may see a hike in the prime rate of 100 basis points and possibly complemented by other measures. Why is this? Because the currency has been under pressure.
Right.
Yes, we know that economic fundamentals, there is a substantial trade deficit, a substantial current account deficit in Ghana. Economic fundamentals have not been supportive of the currency, but the Bank of Ghana will want to react early to try to restore some level of confidence, to try to stabilize the exchange rate, rather than run the risk of even greater exchange rate depreciation. There is, of course, another key reason why they should be tightening interest rates today, and that is this gap that has been emerged. If you look at where short-term market interest rates are, they're much higher than where the prime rate is, 15%. We see short-term T-bills at around 22, 23%.
Right.
And in order to make the policy rate effective, the Bank of Ghana would have to look for ways to try to narrow that gap.
All right, so we've seen pretty robust growth in Ghana over the last couple of years, and you're making a call for tightening. If we do see some further tightening today, what impact do you think this is likely to have on the growth rate of Ghana's economy?
Well, there isn't necessarily a hugely robust relationship between the level of the policy rate and growth in the Ghanaian economy. Of course, we've seen this big divergence in recent years, Ghana becoming an oil producer, benefiting from first oil, double-digit growth rates for a short period of time, still very strong growth expected of around 8% thereabouts, and that we think will be the case regardless of any tightening. We need to realize that what we're really talking about is a very technical factor here.
Right.
It's about the effectiveness of the transmission of monetary policy. When you've got such a vast gap between the policy rate and short-term market interest rates, changing that policy rate is unlikely to change very much in the wider economy.
Right. If we move to the government, of course, spending on their side has a huge impact on monetary policy. Are you anticipating any changes in the way the Ghanaian authorities deal with fiscal issues? Because clearly this is having an impact on monetary policy.
Well, yes, a lot of observers have pointed out the fact that Ghana has been running a substantial deficit for some time. We had
Right.
the 12% of GDP deficit last year. It looks as though they will be targeting a 9% of GDP deficit this year. So still substantial fiscal strains, and of course that's one of the reasons why monetary policy needs to be tighter than it might otherwise be, because of the extent of Ghana's fiscal deficit. Now the Ghanaian authorities have committed to reducing the size of that deficit, but they want to do this in a manageable way, and they don't necessarily want to be making promises that they won't be able to keep. So we are looking at a very gradual process of deficit reduction, which should help over time. In the meantime, though, the currency is under pressure, and the Bank of Ghana will need to react to that.
All right, but would 100 basis points move be enough, though? Because, like you did mention, the currency has been under pressure this year. I think it's down about 5% year to date. Do you anticipate further weakness for the cedi?
Well, there are a number of things to mention here. First of all, will they only change the prime rate, or could we see this taking place in concert with a number of different measures? Perhaps a reduction in banks' net open positions that would force the sale of some foreign exchange, perhaps other means of tightening. We don't rule that out either. Will this be enough to impact the cedi? We think that any sign that the authorities are acting in a proactive way will impact on market confidence and will slow the depreciation of the cedi. But the bigger issue is that fundamentals in Ghana, given the export growth of the country, given the import profile that we've seen, fundamentals still suggest that we may see gradual cedi depreciation over time. What the authorities will be trying to do is trying to influence the speed of that depreciation.
Right. Well, we'll see how things play out. Of course, we'll be watching that. Thank you so much, Razia Khan from Standard Chartered, talking us through what we should expect from Ghana's monetary policy.